Hello there, my name is Nick. So today I'm going to show you how I build the financial models. In most of these cases, they are technology startups, early stage, probably up to Series B type of companies. But obviously, you can add more functionality if you need for more complex type of companies. Okay, so. Starting with, a lot of people ask me, oh, why do I need a full-blown financial model where I'm early stage? All I need is just a list of expenses, maybe some revenue projections, and that's it. Well, of course, you can go with something like that. But when it comes to funding outside what we call the 3Fs, friends, family, and fools in quotation, even an angel investor of like a, $20,000, $50,000, $100,000 ticket, they need to know where they're putting the money, okay, and what is really your future cash flow, how this is going to unfold, how many different revenue streams you're going to have, when they're going to kick off, and what is really the potential, okay, here. Now, they know, especially if you are in the early stage, they know that this is more like a guess estimate at this stage. They know that a lot of things will change along the way, but they want to test, have you thought about this? Have you thought about that? So the way that I built the financial models is not just about having a P&L or a cash flow or a balance sheet, okay? It is more like a tool that you can use along the way to, you plug in your new assumptions once you validate, a new product, a new service, and you run again the numbers to see where you're getting, okay? So there are many tabs here, okay? I'm gonna go through a few to understand how adjustable and how tweakable this model is. This is from a SaaS model, okay? So I'm gonna show you some specific SaaS metrics here, but obviously every model is customizable for the needs of each project, okay? So if I go to the controls, this is a tab which applies to the whole model. Okay, like when you're going to start, what is your currency selection? Here we have a few currency selections, different types. Cash at hand is how much cash this company is having at the moment you run this model, and some other stuff about accounts receivable, how much you collect online. Obviously, this is a SaaS model, should be 100%. Accounts payable, corporate tax that is in the UK, so it's 25%, and inflation rate because that plays a role. When we did this model, the inflation rate was high. And now hopefully will drop, okay? And some other scenarios about optimistic, conservative, what you can show you later, okay? Now, the whole model is adjustable when it comes to this kind of tabs. So, for example, if you say, no, my cash, for example, is 30% cash and 70% collectible, you change this yellowish type of tab and the model adjusts accordingly for the whole, okay? So let me go to the hiring plan, okay? And the hiring plan is something that a lot of investors play, a lot of attention, and you should as well as a founder, okay? Because this is so critical for the success. So here in the hiring plan, we lay out all these kind of different roles that this company will need, okay, with function, different type of leadership, associate, and so on. But look at this, which is probably the most important, is when all these people are going to start. So these guys, they're going to need, I think at the end is about 44 people, okay? 15 UK, 29 remote, but they don't hire everyone, So it goes 44, but they have 11 on year one, then they added 22, 8, and 3, okay? So it's very important, okay? And offshore, tech startups that don't need to have everyone sitting in London or New York or Sydney or where they are, which is very expensive. So they do a mixture between on-site and offshore. So if I go to payroll, for example, you see here, this the kind of how they scale in terms of the employees. Okay. Now the other stuff here about compensation and travel and assets and things like that I'm not going to go through that benefits for full-time employees, so you get the idea how this is built. Let me go to contractors now, okay? So it's very common where at the beginning of a startup, you have a lot of outsourcing activities, right? You have marketing in most cases, you have development, maybe some advisors, okay? So here we have the contractors, and contractors are different from full-time employees because they hit your OPEX. At the same time, when you don't need a contractor, you have a 1 or 2 months notice, then you lay off this person, okay? Now, what happens here, you see here, they start building up some of the people. So, for example, they want a data quality expert coming on year 2, but then they don't need him for anymore. So it stops, okay? So it's zero, it goes at the start of year two, 50,000 pounds. Then nil means I don't want this person anymore. It stops. What happens with the others? Sometimes they have, for example, here some of the marketing activities. So in some cases, we do the transition between outsourcing and full-time. Okay, so you may have, let's say, you pay like £100,000 or dollars on a marketing activities outsourcing, but then eventually you start building your team from year 3, for example, in-house. Then we show this transition where your OPEX drops when it comes to marketing activities and you build up salaries, okay? So this model gives you that flexibility to run this kind of strategies. Okay, marketing budget, okay? So this, in some models, what they do, they just put a bulk, okay? Or how much do I need for marketing? I need £100,000. Okay, fine. You add it there. Now, there are many questions from investors because, you can splash out a lot of money on marketing, okay? And with no really good return on investment. So a lot of investors will ask, okay, what is your CAC? Okay, what is your acquisition cost or the lead, the cost of per lead? Okay, what channels you're going to use? Okay, so here in this example, because we've done the marketing, client has done the marketing strategy, we know what kind of channels we need. We know roughly the budget. This is not going to start, all of it going to start at the same time, okay? Year 1 growth, and then we kind of know the CAC because it's an existing business, okay? So we know that is about £10 for a B2B, it's a B2B model for a new user, okay? New users means registration, doesn't mean client yet, okay? The client, it needs more effort. Now, I want to show you another trick, so when it comes to planning, okay? So as you can see here, we have a starting month. So that means that the LinkedIn, for example, ads, they're not going to start until month 6 of year 1. Okay. Now, if I want to change the strategy, say, oh, well, now I'm changed my mind. I want to start this sooner than I want to go month 2, for example. Okay. So you change that and the whole model tweaks around to change the starting month. Okay. So it takes the division of this kind of budget you have per month and you add it month on month, like with some increase, obviously, some growth rate, okay? That is very something which is very handy when it comes to resource planning, when it comes to revenue, because sometimes you don't have all the revenue streams starting at the same time, okay? So let me roll back to that. Or if you want growth rate, obviously, to be 0, then it would be 0, so be flat each month. If you want to go, more aggressive, for example, 30%, then it will apply a 30% growth rate month on month, okay, until you get to that. Okay, I will back. Let's go to revenue. Okay, so so this is obviously, it is a SaaS model. Okay, so we have subscriptions. So what happens here? We have a pretty much an estimation of where these clients will come from, okay? So you see here we have some actual data because they have actually users. Then we get new users from marketing, you see here, because we estimate the CAC per lead. So that means new users doesn't mean new clients. The new clients are here, I will explain, okay? Existing new users, so we add up this, and then we have some DB cleanup, which is a standard process that usually maybe it's not 3%, maybe it's 1% every month. Some people, some emails bounce, people get interested, or the chance they want to delete their account, whatever it is, there always should be something here to clean up. Maybe it's 1% instead of 3%, okay? you adjust the numbers. In this case, it's 3%. Then we have total registered users after the cleanup, existing clients, okay, and then you add, you have the churn clients, okay, and then you have the new clients, okay, and the new clients come from, you see here, the CAC for the new client, in this case, because it's a B2B, is £333, okay, in this month. So it's not the £10 you saw before, this is the cost per lead, okay? And then we have the subscription, because these guys obviously have the level 1 subscription, they have the level 2, the level 3, and what we do here is we have the monthly, we have the discount on annual if they, they pay the annual, and then we have the split, how many of these users in subscription 1 level will fall under the monthly split or the annual split, and some other add-ons. I mean, this is specific to their model, obviously. We're not in the model, every model we build will be different, okay? So, and then you have all these, and they, all these key metrics are very important for SaaS. Average revenue per client, MRR, ARR, churn rate, LTV to CAC. You're gonna need that in if you build a SaaS model. Okay. Now, if I collapse all this, then obviously you get the yearly. Okay. If I expand, you get year one, and you see it per month how it's growing. Okay. That is for the revenue, and then in the revenue summary, you see that in a more summarized version, okay? So you have all these type of subscriptions that they have, some affiliate they have, and where the revenue comes from. And this is a very important metric, because a lot of investors will ask you, okay, how much of your revenue comes from a single type of subscription or a single revenue stream, okay, if you like. There are models where they rely 90% or one revenue stream. Sometimes they don't like that because they feel the dependency. So that's why we create this kind of metrics. In this case, it's more balanced because it's a SaaS, so they have 40% in the pro monthly, 20% on basic, okay, and it's distributed differently. Okay, so here are other metrics about subscription, registered users, paid, okay, the CAC group per month, how many subscribers they have, so it's always a metric here, okay. All right, so let's go now to expenses, okay. The expenses follow a similar logic when it comes to things like we saw before, okay. Some of the costs won't start, I mean, these guys, for example, they don't need an office until the beginning of year 3, month 25, okay. They don't need, for example, this kind of compliance until later, okay, or penetration testing, they will do it later, okay. But some of them start month 1, okay. And so you see here, some of them stop. So what I told you before, marketing agency, okay, they pay something per month, there is a growth for year 2, but then they stop because they built the team in-house, okay. So what that means in your OPEX, you see here, marketing 12,000, 1440, and then 0, okay. That's the logic of how you build your strategy when you want to do this kind of transition, because these things are likely to happen in future, okay. Some other things about direct costs, online payment processing, how much affiliate is costing them, infrastructure, okay, which are direct costs because they are tech. So how much, and you see this is going to skyrocket because obviously they're going to have a lot of storage and processing as they grow, okay? Now, I'm not going to bore you with other stuff here. Obviously, there are things like, income statement that you have per month, per year. You can check it, here if you're more detail. Balance sheet, okay? Cash flow, okay? And I will explain this issue of equity because they need to raise funding for this to stay, cash flow positive. Before I go to funding, let me just go to the summary, okay? So in the summary tab is something that we summarize, okay? So you see here, they have the income statement in thousands, COGS, net earnings, EBITDA, EBITDA, and you see here that these guys, for example, they estimate they have some kind of profit here in year 3, okay? Some other key metrics, DCF would do for valuation. Obviously, we do maybe the multiples, whatever methodology the client wants. I'm not going to go through the valuation now. It's probably for another video. IRR, annualized ROI, payback, break even, very important. So all these metrics are calculated. Okay, so they are not like what is your break even? Oh, it's between maybe year 3. So in this model, this tells you month 25, okay? Obviously, if you change your assumptions, these numbers change. And other SaaS metrics, very important, as I showed you before, as a 5-year average, CAC, LTV, revenue churn, marketing to revenue, revenue per a full-time employee, an important metric. So, how much it's, as you grow the company, how much revenue you expect to get from each of your full-time employees, okay? So obviously, you take an average here because this is maybe some would think is too high for year 5. And some other metrics here, net profit ratios, monthly burn rate, very important, okay? So financing now, okay? So let me go to this because this is important. What a lot of startups do, and other companies, not just startups, instead of estimating, instead of actually allowing the model to calculate how much funding you need, okay, based on your inputs, what they do, that they hand code, I need $2 million, I need $5 million, I need $1 million, okay? And then after the $1 million, they start subtracting OPEX, salaries, technology costs, marketing, direct costs, and all that stuff, okay? And they say, okay, then I'm going to be left with $50,000 cash flow at the end of year 1, okay? Well, we do the way around, the completely different way, okay? We allow the model to tell us how much you need, okay? Because you plug in your inputs in terms of salaries, wages, revenue, obviously, other costs you have, and we say, okay, how much do I need? So these guys, they need roughly 2 million, okay, British pounds for 24 months, okay? We estimate, we put here some contingency amount, some financing fee they're going to have to pay some agents. We take into consideration, obviously, the revenue they're going to have, okay? And then financing, fixed assets, direct costs, salaries, and all that stuff, okay? And they, what this model tells you now is that if you raise 750,000, okay, and you want to have a runaway of 1 year plus 6 months, okay? In this model, that's how we wanted to do it, roughly 18 months, then you're going to have roughly 400,000 pounds at the end of the first 12 months, okay? Why you have another 6 months? Because your burn rate, you see here, this calculation takes it from the burn rate. So in the burn rate, you burn around 65,000, okay? So roughly gives you another 6 months, okay, for this money until you have to raise again, okay? And the same logic goes here, where you raise a second round of 1.3 with another 12 months plus 6, 18 months runaway, okay? Now, why is it important? Because if you split the rounds, as you know, then you're going to give away less equity, okay? The valuation every time is higher. Also, investors will be more comfortable when they know, okay, this startup needs about $2 million. I'm not going to, give all the money now. I'm going to give 750 now, and then if they meet XYZ, goals by end of year 1, then I pledge for the rest. Okay, so it's a safe, if you like, guard for both sides, and very transparent. Okay, so so that's all about this video. Hopefully you enjoyed it, and feel free to get in touch if you want to discuss something around that. Thank you.